Thank you for tuning in. My name is Jim Wild. I'm the director of the Merrimack Valley Housing Partnership. And we're a private nonprofit organization. We've been in existence for next year will be our 35th year. The mission of the organization is to promote responsible and sustainable homeownership opportunities for first-time home buyers. And a little bit of the history of the organization. When we started 35 years ago, we worked primarily as developers and built new housing, and then sold all the units off to first-time home buyers. And then about 30 years ago, we shifted our focus from developers to educators. We recognized the need for home buyer education. There was really no formalized way of educating and preparing people for home ownership. So we started doing these classes very much in a vacuum on our own, and we did that for a couple of years. Then we heard about another group in Boston that was doing classes as well, and so we got together and compared notes and best practices. And before you know it, there were all kinds of other groups joining, and so we all got together. We formed what's known as the Massachusetts Homeownership Collaborative. It's under the management of the Citizens Housing and Planning Association, which is known as CHAPA. And so the collaborative has put together a curriculum for homebuyer education that we all have followed all of these years. And we also have a code of ethics that we abide by. So by having we have a seal of approval from this collaborative, which means that we follow the curriculum and that we abide by a code of ethics. And it's really been a good thing in terms of elevating the quality and the consistency of homebuyer education throughout Massachusetts. So we started doing these classes in person, and which we still do. That's most of our activity is doing classes in person. We do the classes in English and Spanish. We also team up with the Cambodia Mutual Assistance Association to do the classes in Khmer. But about 5 or 6 years ago, we joined in and started offering the classes online. So we did, the course that we use now is called Framework. It's an excellent class. So if you're watching this video, you probably just finished taking the Framework course independently. And now this session is a follow-up to that class. We typically do these classes in person once a month. It's about an hour and a half long, and because of the pandemic, we're now switching over to doing this remotely. So we're taping it with the help of Lowell Telecommunications Corporation, and so it'll be available for the folks that take Framework. So anyhow, let's get started. It's a little bit of the history. So now I want to talk about the key points of home buying that we as a nonprofit involved with helping first-time home buyers think are really the most important things that you need to be aware of when you're going about buying a house. So we've got a lot to cover, and I will first start off talking about who everybody is when you decide to buy a house. When you decide to buy a house, there's all kinds of people that come out of the woodwork who are involved with the process of buying a house. So I want to explain who everybody is, what their role is, who they work for, how they are paid, and all of that. So let's start off with the buyer and the seller. Pretty simple. You're the buyer, and someone that is currently living in the house that you want to buy, they're the seller. Okay, the first person that I'm going to talk about is the lender. Most of us have to go to some type of financial institution to borrow money to buy the house with, called a mortgage. So sitting here thinking about, where do I go and ask for, a lot of money to buy a house with? You've got a lot of different choices. There's a lot of different types of lenders out there. You'll have big banks. You have big international financial institutions. These are banks that are all over the country. They're all over the world. They do mortgages. They do car loans. They have business loans. They do college loans. They have ATM machines. They have branches. So they're really full-service lenders with a big footprint. Then that's one option. Then you have another option, which is smaller, more locally focused financial institutions. These are, if they're in Massachusetts, they're typically chartered by the Massachusetts Division of Banks. And those are, and fortunately in this area where we are in Greater Lowell, there's an abundance of excellent local lenders. And then you have another option, which is credit unions. Credit unions are banks in many ways, but there are a few differences. They're owned by their shareholders, and they're also nonprofit institutions. So you've got big banks, smaller banks, credit unions, and then there's another source of mortgages, which is mortgage companies. So mortgage companies are companies that only do mortgages. So they don't have branches. They don't have ATM machines. They don't do car loans or personal loans or anything like that. All they do is mortgages. So here we are sitting home thinking about buying a house and needing a mortgage, figuring out, where do I go? Do I go to a big bank, a small bank, a credit union, or a mortgage company? The answer is, you really have to look at all of your options. You have to really do some homework and research. It's not hard to do, but the key point is, the key reason is, a lot of these different lenders carry different types of mortgage products. You really need to be thinking about mortgages as a product, not just an amount of money that you need to buy the house with. There are mortgage programs that are designed for first-time home buyers. There's a few that we want all of our graduates to be aware of. The MHP1 mortgage program, which is funded by the Massachusetts Housing Partnership. MHP1 is the mortgage product. There's also mass housing loans. There's a lot of other loans that are unique to individual lenders. There are FHA loans, VA, conventional loans, Fannie Mae, Freddie Mac, alphabet soup, lots of different mortgage programs. So each one of these mortgage programs is designed for a certain type of buyer. And whether you're a first-time home buyer or a second or third-time home buyer, but with different credit scores, different amounts of down payment, different considerations. So you really have to look at all of your options. So we'll talk more about that later. So lender is very important. Obviously, besides finding the house, the right house, probably the biggest decision you're going to make. Then you have real estate brokers. Real estate brokers' primary function is to introduce buyers and sellers to each other. They help with that. They also facilitate the process. They know how it's done. They do it every day. So they know what order things have to happen, who is involved, when you need certain documents and paperwork, and when things have to happen. And so real estate brokers, there's basically two types of real estate brokers. There are real estate brokers who represent sellers, and there are real estate brokers who represent buyers. So if you're a seller wants to sell his house, he could, go buy a for sale by owner sign and plunk it down in his front yard and try to sell it on his or her own. Or he or she could list the property with a real estate agent. So the real estate agent working for the seller, they're going to come out, look at the property, they're going to go back and do a market analysis and compare other properties that have sold and do some research to come back and suggest how to price the house and how to stage it, how to make it look attractive, to make the most interest in the property. So if a seller decides to enter into a contract with a seller agent, they're going to sign a contract, and they're also, in that contract, they're going to agree on a commission. Real estate brokers are only paid at the closing table. They only get paid if and when the property sells. And the amount of compensation is always negotiated. It's a percentage of the sales price, and it varies from deal to deal. So the seller is entering into a contract with the real estate broker who's going to enter that property into the multiple listing service and make it available and known to all licensed real estate brokers who subscribe to the multiple listing service, which is basically all of them. So thousands of people instantly know about this property for sale. So now you're a buyer, so you want to be working with a real estate agent who represents you. So your real estate agent is known as a buyer agent. That buyer agent is going to sit down with you, really talk to you in depth about what you're looking for, what your needs are, what's your price range, what's important to you, and they're also going to educate you about the market. They're going to educate you about what's available in your price range. How competitive is the market? How do you best position yourself to be competitive with other buyers? So that buyer agent is going to work with you throughout the process. And so if you want to see a property, the buyer agent arranges for the showing. If you make an offer on the property, you make it to your buyer agent. That buyer agent presents it to the seller's agent. The seller's agent refers it to the seller, and then the answer comes back in the same channel. So that's how that's done. The nice thing about being a buyer is that, and having a buyer agent, is that the seller is really the one paying the commission. So, as I said before, the seller is paying the seller's real estate broker a percentage of the sales price, the commission at the sale. Right up front, when the contract is signed, they agree in advance how they will share that commission with another real estate broker. Typically, it's 50-50. So whatever the real estate commission is, divided by 2 is what your buyer agent would get. So the seller's paying the commission, and so that's a nice thing for the buyer. You know, keep in mind, someday down the road, you'll be the seller, and that'll be your time to pay the commission. So real estate brokers, lenders. The next person I want to talk to, and I'll talk about both of them at the same time, personal attorney and the lender's attorney. With the personal attorney, the process of buying a house is two-step. You make an offer on a property. And then once the offer is accepted, the next legal document is the purchase and sale agreement, known as the P&S, the purchase and sale agreement. So those are both legally binding contracts. Once the seller signs those contracts, you have a property under agreement. You've agreed to purchase a property on certain terms, and the seller's agreed to sell you that property on certain terms. So that property is technically off the market. Once the seller accepts your offer, they can't turn around and sell it to another person who's willing to pay more. They have to honor your contract. So it's very important, particularly with the purchase and sale agreement, that you always have an attorney review that contract before you sign it. Those contracts are inherently written in favor of sellers. Very important that you have an attorney review the contracts before you sign them. So that's your personal attorney. The lender's attorney is the attorney that you pay for as part of your closing costs. Part of the cost of getting a mortgage, you've got closing costs. Part of the cost is to pay for the attorney that represents your lender. That attorney is doing a lot of work in the transaction. The first thing they're doing is they're doing a title search on the property. They look at the ownership of the property going back 50 years. They want to make sure that every transaction that's happened with that property was settled, clearly, and they guarantee that the day that you purchase the property, nobody else in the world has a lien or a claim to that property. So they're protecting the lender. Keep in mind, you may be putting down 5% of the purchase price. The lender's putting down 95% of the purchase price. So they have a lot more money in the deal than you do. So they really need to make sure that everything is done properly and they're protected. So that's the job of the lender's attorney. So the lender's attorney, does the title search. They also host the closing. They make sure the existing mortgages get paid off. They make sure that the new mortgages get filed properly, and there's a lot of different things that they do. So they handle all the money. They host the closing. So that's the personal attorney and the lender's attorney. Next person, home inspector. Once you find a house and you make an offer and the offer is accepted, you should really get a home inspection. Home inspections are not required. They are with certain mortgage programs, but in general, it's the buyer's choice. We always recommend you get a home inspection. The rare exception is if you were buying a brand new construction that came with guarantees, excuse me, or things like that. So home inspections typically take 2 or 3 hours, and they come out and they look at everything. They usually start in the basement. They look at the heating system, the plumbing, the electrical. They look at the foundation. They look at the roof. They look at everything having to do with the house. And then they're going to give you a report about what they find. And it's always a good idea to be with the home inspector when they're doing the home inspection. And because it's a very serious time, and they're, these are really trained, excellent, talented professionals who most of the ones certainly the ones that come and teach our class have done thousands of home inspections. So they've seen everything under the sun, and they know what to look for, and so basically the home inspection is an opportunity for you to be aware of what you're buying. The home inspection, what is it and what isn't it? A home inspection, the home inspector is not going to ask you what you're paying for the house. It's not their area of concern. Their area of concern is the physical condition of the property. They're not going to tell you whether to buy it or sell it, or buy it or not buy it. They're really just telling you the condition of the property. So if you read between the lines and all of that, you can get a good sense of, are you buying a house that needs a lot of work? Do you have the money to do that work? Are you prepared to do it? And home inspectors, a few things that they're not allowed to do. They're not allowed to give you cost estimates. They may discover it needs a new heating system, or the roof needs to be repaired, or the electricity needs to be upgraded. That's their job, is to point that out to you. They are not allowed to tell you how much that's going to cost, and they're not also allowed to make referrals. Those are to contractors to do those, to fix the problem, because those are consumer protection things. So if a home inspector points out to you, you need the electricity needs to be upgraded, you still want to purchase the property, then the next step would be to hire an electrician, or ask an electrician to come in and evaluate the situation, and then they can give you a cost estimate. They're the person who would be doing the work. So home inspections are terrific. No house is perfect. Even, every house has some type of issue. It's just a matter of how serious it is and whether that's going to affect your decision to buy it or not. But the best money you can spend is to get a home inspection. Okay, so insurance agent. As long as you have a mortgage, the lender is always going to require you to insure the property, homeowner's insurance or hazard insurance. This is insurance that protects you against fire, theft, hurricanes, earthquakes, things like that. You'll have to, a couple of weeks before your closing, you'll get a call from the closing attorney asking if you have an insurance binder. So a binder means that you've purchased the insurance and paid for it 1 year in advance, and then they're going to give you a letter known as a binder that is given to the closing attorney in order for the closing to proceed. That's the lender's attorney doing the closing is protecting the lender and wants to make sure that the insurance is in place at the time of purchase. So the homeowner's insurance, and I'll be talking about that a little bit more later in detail, but you need to buy homeowner's insurance. Then you have an appraiser. An appraiser is someone that the bank hires to go out and do a market analysis of the property. They typically don't do that until they've approved you and they feel comfortable lending you the money to buy the house with. The appraiser is to make sure that the house is worth what you're paying for it. So they send out an appraiser who's going to do a pretty in-depth evaluation of the property. They're going to look at a lot of different variables with the house. They're going to compare the house that you're buying with as many other comparable properties that are in close proximity that have closed recently, and compare your house with all these other properties, and then put a price on the house and saying, based on this, compared to all these other recent sales, this house is worth this amount of money. So the appraiser is kind of a sanity check to make sure that you're not overpaying for the property and the bank's not over-lending for the property. So that's what the appraiser does. Okay, so those are all the people that you're going to encounter. On the seller, it's a lot easier to be a seller sometimes. They just need a real estate broker and or an attorney. They don't need to get a home inspection. They don't need to buy insurance. They don't need to have to get a mortgage. So their job is, it's a lot easier, particularly in a seller's market. So anyhow, those are all the people that are involved with a typical real estate transaction. Okay, now looking at that list, who is the most important person there? Who's the most important person on that whole list? The answer is you, the buyer. Think about this. If without you, the seller doesn't sell his house. A lender doesn't make mortgages. Real estate brokers don't earn their commissions. Attorneys don't earn their fees. Home inspectors don't earn their fees. Insurance agents don't write insurance. Appraisers don't get their fees for performing appraisals. In addition to that, big departments, hardware stores don't sell lawnmowers and snowblowers, and appliance stores don't sell wash machines and refrigerators, and furniture stores don't sell bedroom sets and living room sets and all those other things that home buyers buy. And so when you think about a buyer, it's a huge driver of the economy in general. It has an enormous ripple effect. When you buy a house, look at all the people that have been employed, all the people who made commissions or earned money or things that you bought that really drives the economy. So the reason I like to make that point is all the people you're working with on this list, these are seasoned professionals who do this every day. They know the lingo, they know the process. You're a first-time home buyer. You've never done this before. This is all new. It's intimidating, it's scary, it's a lot of money. So if you go into this and think of yourself as really, being the most important person here, then you're going to have, you should have very high expectations of the level, the quality of service that you'll get from real estate professionals. Whether they're brokers or lenders, attorneys, home inspectors, whoever they are, you want to work with the best and you want to have really good service. And people who answer your questions, people who answer their phone, people who call you back in minutes, not days or hours. In this real estate market, you have to be on top of it, and so don't your real estate professionals. It's so competitive. If a property comes on the market in the morning and it's priced right, very good chance it's under agreement by the end of the day or midday. And so you need someone who's, when it comes to real estate brokers, someone who's checking the multiple listing service several times a day, calls you at work and says, hey, a house just came on the market that fits the bill of what you're looking for, let's go see it. We'll go in at 1 o'clock this afternoon. You want to be the first in line. So you really need to be working with people who are aggressive. This is a 24/7 business. And so don't be bashful, don't be shy, and expect really good service. And plus, these professionals love working with first-time home buyers that have been through homebuyer training classes. You're more prepared. You ask better questions. You're more informed about the process. And so it's a joy to work with people who are more prepared. So keep that in mind. Okay, so those are all the people that you're going to encounter when you decide to buy a house. Now, let's talk about the process. Where do you start? Okay, the first thing is what you're doing right now, finishing up a course, a homebuyer training class. And buying a house, it's the most expensive thing most of us will buy in a lifetime. It's a big deal, it's expensive, it's emotional. Investing, 8 or 10 hours of your life into figuring out, being prepared is certainly worth it. We spend a lot of time, a lot more time in evaluating other things that we do in life. This is one of the biggest purchases, so it's really useful to spend some time figuring it out and educating yourself. So take a class. You've done that. The next thing you want to do is get your financing lined up. Before you even look at properties, before you think of anything else, you need to get your financing lined up. So we recommend that you get pre-qualified by a few different lenders. And so what does that mean, a pre-qualification? A pre-qualification is when you talk to a lender, they basically need a few pieces of information from you. They need to know what your income is. They need to know how much money you have saved for down payment. They need to know how much money you owe other people, creditors, credit reports, college loans, credit cards, college loans, automobile loans. And then they also need to know your credit score. So based on those 4 pieces of information, they can easily plug it into formulas that they have that will determine your financial range for qualifying for a mortgage, and also the type of mortgage program. So what we recommend you do is to get a copy of your credit report. We can do that for you through our office, and you can go to our website. We'll explain how we can do that. But you want to get a credit report that's, the credit reports that we do not, when we pull them, they don't count as an inquiry on you, because we're doing it for purposes of counseling, not issuing credit. So we have a special relationship with the credit bureaus. And it gives you the credit scores, and it's the same formula and the same credit report that a lender would get when they're evaluating your mortgage application, which is a different formula from Credit Karma, from car loans and other types of things. It's a more stringent formula. So you want to deal with the real number of whatever that credit score is. So get a copy of your credit report and then start talking to lenders. You can do it in 5 or 10 minutes over the phone. Hi, I'm interested in getting a mortgage. What do you have? Is it a mass housing loan? Is it an MHP1 loan? Is it a VA loan? A VA loan? A conventional loan? A portfolio loan? And they'll ask those questions, and you've got the answers readily for them. You don't want to authorize everyone you talk to pull a credit report. You've got your number. Just say, I'm not authorizing you to pull my credit report. This is my score. I just got it from the Merrimack Valley Housing Partnership, or from annualcreditreport.com if you do it on your own. And they'll give you an idea of how much of a mortgage you qualify for and what type of mortgage program it would be. So you talk to 3 or 4 or 5 different lenders. You can educate yourself pretty quickly on the different mortgage programs. And keep in mind, lenders all carry different products. Some of them overlap. Some of them only do FHA loans. Some of them only do some of the first-time homebuyer programs. Some of them do a mix of them. So you really need to shop around. And so, because the cost on a monthly basis of choosing one mortgage program over another in borrowing the same amount of money can vary greatly. You can easily be paying $200 or $300 a month more to borrow the same amount of money if you pick a mortgage program that wasn't as good as the one that you would be eligible for. So it's really on you to shop around and make sure you're getting the best program. Use us as a resource. Call us up and we'll tell you about the different programs or whatever. So anyhow, you want to get pre-qualified by a few different lenders to find out, who has the best program for me and how much would I qualify for. Then, once you have that information, then you select the lender who has the best program, and then you go through the formal application process. You actually, apply for a loan. And then what you get is known as a pre-approval. So the shopping part is pre-qualification. When you're actually selecting a lender and getting approved, it's a pre-approval. That's when you pay an application fee. The lender pulls a copy of your credit report themselves. And then they give you a letter saying, congratulations, we've approved you for a loan of this amount of money, and this is the interest rate, this is the type of mortgage program. So now you have a piece of paper that says, I've been to the bank has evaluated my financial situation, they feel comfortable lending me this amount of money, that's my price range. That's great. You really can't do anything until you've done that. So the next thing you want to do is, quickly think about how much do you want to spend. Banks are going to tell you what's the most that they feel comfortable lending you. These are based on formulas and national averages and things, but you may feel like you'd rather have a lower payment because for whatever reason, you may choose to borrow less. So think about, how much do you want to spend? And this is, everything you're thinking about is your monthly cash flow. How much is my monthly mortgage payment? What percentage of my income is that? What do I have left over for everything else? So think about what kind of payment you feel comfortable with. Then decide what kind of house do you want to buy? Do you want to buy a condominium? Condos are great. You don't have to mow the lawn. You don't have to shovel snow. You can go away for the weekend, close the door, and not worry about anything. Or do you want to buy a single family house and there's no condo association, but there is, everything is on you to maintain? Or do you want to buy a 2 or 3 family house and not only own your own home, but be a landlord, go into the business of being a landlord? With a condominium, you're paying a monthly condominium association fee. So you're paying a fee into the condominium association to pay for the master insurance policy as well as the maintenance of the property. Buying a single family house or a 2 or 3 family house, there is no condominium association, so there's no fee there, but it's on you. So all of these are different lifestyles. If you are interested in buying a multifamily property, you're going to be a landlord. In which case, we strongly recommend that you take our landlord training class. It's a 4.5-hour course. It goes A to Z about how to be a good landlord. How do you select tenants? What are all the laws regarding security deposits and last month's rent? And what are the different types of leases? And how do you deal with housing court and evictions and all of those things? So certainly worth your time to really study that as an option. It's not for everybody. It's great if you've got the right constitution and you're a good judge of character and you're a good manager of the property, but it can be a great thing or not a great thing depending on you and depending on a little bit of luck and all depending. It really comes down to picking the right tenants. So lots of different things that you can buy. Then the fun starts. This is when you choose your buyer broker and you start looking. So by the time this happens, you've already done quite a bit of work. You've researched all your financing options. You've gone through the mortgage application process. Whatever questions the bank has about your finances and credit history and all of that stuff, you've dealt with all of that. Now you're pre-approved. You have a good idea of what you're looking for. You know your price range. Now you can go to a buyer agent and say, I'm approved for this amount of money and I'm looking for a single family house in this area and I need to have handicap accessibility. I need to have 3 bedrooms and 1.5 baths. I need whatever. So whatever's important to you, and then that buyer agent's going to, educate you about the market and then start showing you properties. So you choose your broker and you start looking. Whether you look at one house or 50 houses, when you find the one that's right for you, you make an offer. And then the offer gets accepted, or you negotiate back and forth. Once the offer is accepted, then you get a home inspection. And you typically need to get a home inspection within 10 days of having an accepted offer. So you want to have your home inspector lined up in advance. You know who you're going to call when that happens. Then you have an attorney review your purchase and sale agreement before you sign it. So the legal process is you make an offer, then you have your home inspection, and then you enter into the purchase and sale agreement. This is the legally binding contract. Everything in real estate is negotiated. It has to be in writing to be valid or to be enforceable. So everything from how much you're paying for it to when you're going to close to what kind of mortgage program you're going to get, and are the drapes going to stay? Is the chandelier going to stay? Is the swing set in the backyard going to stay? Are all the stuff that's in the basement going to be moved out by the time you move? It'll be in broom clean condition. Whatever is important to you has to be in writing in that contract for it to be enforceable, which is why it's so important for an attorney representing you to review it. So you sign your purchase and sale agreement. Now you have a deal. You've got, everybody knows what's going to happen, who's going to pay for what kind of program you're going to get, and all of that. Then you've got to go get your homeowner's insurance. And this is when and I'm going to be talking about insurance a little bit, but you go out and you buy your homeowner's insurance. You pay for the first year in advance, and the way that works is homeowner's insurance is due once a year. So let's say the homeowner's insurance was $600, just for an example. So you pay $600 to the insurance agent at the time of purchasing the insurance, a couple of weeks before you buy the house, before you close. And the insurance agent gives you that binder, and then the closing can proceed because the bank knows that you have the property's insured. And so a year from now, the 1-year anniversary of your loan, there's going to be another bill for $600 for the insurance for year 2. So what the bank does is they look at the $600, they divide it by 12 months, come up with $50 a month, and they're going to add that to your mortgage payment. So every month when you make your mortgage payment, whether it's electronic or you write a check or automatic deposit, however, they're going to take the principal and interest portion and apply it to the loan, and then they're going to take $50 a month and put it into an escrow account. An escrow account is a savings account. It's your money, it's your name on it. It's being held for a particular purpose. So every month, $50 is going to go into that account. On the 1-year anniversary of your loan, the bank is going to take the $600 out of that and purchase your insurance for you. So they put you on a budget right away. You don't get hit with the big bill down the road. So, and they're going to do the same thing with your property taxes, which I'll explain in a little bit. Okay, then we go to the closing. The closing is when you sign your name probably 50 times. You write your initials probably 150 times, no exaggeration. In this paperless society we live in, the paperwork's an inch thick or more. And anyhow, the closing is when you become the owner. So they usually last about 45 minutes. There should be no surprises at that point. And they're happening electronically now most of the time. And so they used to mostly happen at the Registry of Deeds, but now they can happen at lawyers' offices, real estate offices, anywhere. So you go to the closing and you walk out of there with no money and a set of keys and a 30-year mortgage and a moving truck, and you move in and have a party. So that's how you do it. Okay, now the single most important piece of advice that we can give you as you approach the biggest purchase of your life is to pick the best team. It all comes down to having the best team. Everybody needs a lender. Everybody needs a buyer agent. Everybody needs a home inspector, an attorney, and an insurance agent. That is your team. So before you do anything, before you go to an open house, before you start looking at properties, before you make an offer, you want to put your team together. Do all your homework up front. Shop around for lenders. Who's got the best mortgage programs out there? What do I qualify for? Who's a really good buyer agent out there? Get referrals, talk to your friends, interview people. There are some terrific people out there. Those who are and there's some not so terrific people. You want to work with the terrific people. You are only going to be a first-time home buyer once. This is the biggest purchase you're going to make in a lifetime. You've already invested time in a course. You owe it to yourself to find the best people to work with. There's no reason you can't work with the best. And so, put your team together: lender, buyer agent, home inspector, attorney, insurance agent. So once you have your team together, then you're ready to execute. Then you're ready to start the process. Think about, if you don't approach it that way, you're making decisions that are not really thought out. You're using professionals who were referred to you from people who you haven't really vetted. You really want to work with the best. So that is the single best piece of advice we can give you as you start this wonderful process of becoming a homeowner. Okay, places to educate yourself or sources of information for doing your homework. The tax assessor's office at City Hall. I want to talk about taxes for a little bit. Taxes are property taxes. So cities and towns, who pays for the fire department, the school department, the police department, maintenance of the roads, things like that? Where does that money come from? Well, cities in Massachusetts, everybody in Massachusetts pays income tax to the state of Massachusetts. So we all pay 5 1/8% of our income to the state of Massachusetts. State of Massachusetts collects all that money. They keep some to run the state. Then they take a big chunk of it and they return it to the 351 cities and towns in Massachusetts, and that's called local aid. So they're giving money to the cities and towns to help them pay their bills, to run their schools and fire departments and police departments and public safety and all of the other responsibilities of a municipality. So, but that's not all the money they need. They need more than what they get in local aid. So where's the other money come from? It comes from homeowners. A big chunk of it comes from property taxes. So the city, every municipality goes around every few years and puts what's known as assessed value. They assess every piece of property and they put a value on it. And then they have a tax rate. So you pay taxes based on the assessed value of your house. So if you live in a house that's worth $100,000, maybe your taxes are $1,000 a year. $200,000 a year, they might be $2,000 a year. $300,000 a year, assessed value, $3,000 a year. So whatever your taxes are, it's based on the assessed value of your house. Don't confuse the assessed value with the appraised value or the market value. That's really what the house is worth. And that's a dynamic thing that's always going up and down based on market forces, supply and demand. And the assessed value is, it's done for the purposes of collecting tax revenue. It's not updated as often as the market forces are, so don't confuse the assessed value with the appraised value. But you do want to look at what the taxes are because that's what you're going to be paying every month. So taxes are, so let's say the taxes are $3,600 a year. So $3,600 divided by 12 is $300. So the bank is going to, your lender is going to collect $300 a month, every month from you as part of your mortgage payment, and they're going to put that into that escrow account. So let's say you're putting $300 a month every month for your property taxes, and you're putting $50 a month for your insurance. So $350 is going in every month. Now, cities and towns like their taxes paid to them quarterly. So if your annual tax bill is $3,600, they want $900 every 3 months. So you put in $300 every month. Every 3 months, the bank takes out $900 and sends it to the city, pays the taxes on your behalf. So it makes it easier for you. You don't have to get hit with these big bills every 3 months. You don't have to make the payments yourselves. The bank's doing it all for you, and they're putting you on a budget. So it's easier that way. So that's the taxes. So Lowell Deeds, the Registry of Deeds moved into the beautiful new Lowell Justice Center. And so you can, and the Registry of Deeds is exactly what it sounds like. It's a registry of deeds. Every piece of property in northern Middlesex County, where we are, is listed at the Registry of Deeds. So the they have a terrific website. It's really well managed, lowelldeeds.com. You can go to lowelldeeds.com and search on any property, either by the owner's name or by the address, and you can pops all the information on the property. It's all public information. You'll see deeds. A deed is who owns the property, who they bought, when they bought it, who they bought it from, and how much they paid for it. And it's always tied to the prior deed. So you can trace the ownership back to when the property was built, 100 years ago or more. And so there are deeds, there are mortgages. When people owe mortgages on the property, that's a lien on the property filed by the bank. That's an indicator. So when you go to sell the property, your buyer's attorney is going to discover that there's a mortgage that needs to be paid off, your existing mortgage, and they make sure that gets paid off as part of the transaction. So the Registry of Deeds is where all the information resides. And then the multiple listing service I mentioned, this is the database that all the real estate brokers have access to. Most buyer agents will give you limited access to it, where you can get automatically generated listings every morning, so you can look on, if you're looking at a certain area, and prices between this range in condos or singles or wherever, by zip code, by size, whatever. And then you'll get the listing, and you'll be able to click on and see all the pictures and the descriptions and all of that. So that's the multiple listing service. So those are 3 areas that you can educate yourself about the market. Okay, back to the process a little bit. When you're making an offer, your offer should always be contingent upon a few things to protect your deposit. satisfactory home inspection is one of them, and the ability to obtain your financing. Be specific. So you make an offer, I'll give you this amount of money for your property. My offer is subject to my ability to get a home inspection and be satisfied with the results. It's subject to my ability to get a mortgage if the lender's going to lend me the money to buy the house with. So that's protecting you when you add contingencies to your offer. When you make an offer, you usually make a deposit. Typically it's $1,000. It can be any amount, but you pay money. You write a check to make the offer a legally binding contract, and then in order to protect that deposit, you add these contingencies. Now, in addition to your down payment when you go to buy a house, there are closing costs. There are other costs that we'll talk about in more detail. But there are all these other costs, appraisal fees and legal fees and recording fees and title insurance and things like that. So in addition to your down payment, you've got to come up with a few $1,000s more for your closing costs. So one of the things that one of the techniques that we promote that is pretty successful is when you're making an offer, ask your seller, you can ask the seller to contribute toward your closing costs. I'll pay you X amount of money for your house if you pay $3,000 back, asking you to contribute $3,000 of my closing costs. So the sellers, in their head, they're getting X amount of money minus 3, and that's really what they're going to walk away with. And that money that they're paying your closing costs gets applied to the cost that you have to pay at the closing, which keeps the money in your pocket or reduces the amount of money that you need to come up with. So happens all the time. You just want to think about it in advance and build it into your first offer. So think about that. The purchase and sale agreement, I mentioned it's a legally binding contract. The thing that you want to remember is you never sign that contract until you've had an attorney review it, to make sure that you understand what you're committing to, what are the dates that you have to adhere to, what do you risk losing if you don't meet the requirements that you agreed to do, how do you get extensions or delays if something's going to happen that's going to, like a mortgage commitment is delayed, what do you have to do to protect your deposit and keep the deal on track. So very important that you have an attorney review that contract. Everything is negotiated. I mentioned before, everything that's negotiated has to be put in writing. You can always go back and renegotiate if there are issues with the home inspection. Typically, that's already been resolved by the time you get to the purchase and sale agreement. But that's your opportunity to make changes to the contract based on new information. So, a lot of different types of lenders out there. Just to review. Commercial banks, savings banks, credit unions, mortgage companies, so a lot of different places you can go. This is very important. There are lots of different types of mortgages, as I had mentioned before. The MHP1 mortgage is a terrific program for first-time home buyers, as is the Mass Housing product, which is the Mass Housing Finance Agency's program. So look at those two, go to their websites, educate yourself about them, ask your lenders about them. There are FHA loans, Federal Housing Administration loans. There are Fannie Mae, Federal National Mortgage Association, Freddie Mac, which is the Federal Home Loan Bank. VA loans are terrific if you're a veteran. CRA stands for Community Reinvestment Act. These are loans that lenders make, sometimes with their lending you their own money, portfolio products. Now, one thing I just want to mention very simply is when you go to a lender, 95% of the time or more, when you are getting a loan for a mortgage, they're not lending you their own money. They're tapping into what's known as the secondary mortgage market. These organizations listed are the secondary mortgage market. These are the funders. So you go to XYZ local bank and apply for a mortgage, they're qualifying you for, let's say, an MHP1 loan. And so they're working with a lender who handles that mortgage program, and that loan is actually going to be funded by MHP1. The money will get filtered through your local lender that you're working with, but the money is actually coming from MHP1. Same thing with FHA or VA, and that's really done in order to keep the mortgage market liquid. There's so much money involved with mortgages that banks would run out of money pretty quickly if they were lending their own money. So they need to lend their own money, then sell the loan to one of these people who have pre-agreed to purchase it, and it keeps the bank liquid to make another loan to the next person. So that's not on the test. Anyhow, closing costs. I mentioned closing costs. Some of those things are points. A point is a percentage of the mortgage amount. Some mortgage programs, not too many these days, that sort of comes and goes, but will charge a point tied to the interest rate. If you pay a point, you'll get this interest rate. If you don't pay points, you'll get this rate. So points, appraisal fee, the cost of having an appraiser go out and perform the appraisal. Credit report, when the bank pulls their copy of your credit report. The attorney's fee, that's the fee for the attorney that's representing the lender that's doing the closing. Title insurance for the bank. Title insurance for the buyer, which is optional. I'll talk about that later, very important. Recording fees to record a mortgage and other documents at the Registry of Deeds. There's a recording fee that has to be paid to the state of Massachusetts. And then there is also something else known as prepaids. These are not closing costs because they're not costs associated with the closing. They're not fees, but they're items that other additional funds that a buyer typically has to come up with. They have to pay the mortgage interest in the days remaining in the month that they're closing in. They have to pay their homeowner's insurance premium in a year, 1 year in advance. I talked about that. Mortgage insurance premium. Sometimes, most mortgage programs where a buyer is putting down less than 20% down payment, that requires the lender to purchase mortgage insurance that protects the lender in case of default. And so those premiums have to be paid for as well. Some banks, depending on what you're buying, if it's a multifamily property or whatever, may require that at the end of the day, after you've closed, you've got reserves left over, or they're going to collect 3 months of interest payment, mortgage payment. 3 months of tax payments, real estate taxes, in advance to have a cushion in your escrow account. So those are prepaid items. A typical mortgage payment: principal, interest, taxes, insurance for 30 months. It's a long time, 30 years. So principal and interest. So if you have a 30-year fixed rate mortgage, the principal and interest payment on that mortgage every month for 30 years is going to be the same. However, the split between principal and interest is going to shift every month. So if you're borrowing, let's say that a very small amount of your initial payment is going to be toward principal, and the vast majority, the huge majority of your mortgage payment is going to be on interest. So every month, a little bit more is going to go toward principal and a little bit less is going to go toward interest. But in a typical 30-year fixed rate mortgage, you're in a house for 20 years before more than half your payment is actually paying down the loan, principal. So even though you're purchasing properties at the lowest interest rates you'll probably see in a lifetime, the way mortgages are structured, they're front-end loaded with interest. So a lot of interest is paid up front. So if you made extra principal payments, you can do that anytime you want. You can add an extra payment. You can add a little bit of money to each payment. You can make one extra payment per year, however you want to do it if you want to do it. If you paid one extra mortgage payment a year, if you had 13 payments equal value rather than 12 payments, and you add in a 13th, and you did that every year, you'd pay your mortgage off 7 years early, which is really nice to think about down the road. However, it's not going to change your monthly payment. All it's going to do is help you pay the loan off faster. That's a very kind of enticing thing to think about doing. However, we strongly feel that in the first few years of owning a home, the thing that you really want to be doing is building an emergency fund. Everybody should have 3 to 6 months of living expenses tucked away somewhere in a municipal bond or not buried in the backyard, but in a savings account or something like that, that's liquid and it's only there for emergency. So if it costs you, $3,000 a month to live and pay your mortgage and all your basic expenses, then you should have, $9,000 to $18,000 tucked away in your emergency fund. That's for job loss, for an accident, for some health issue, so that you are prepared for a difficult time if you have to go through that. And once you have your emergency fund set up and established, then you can start making extra principal payments on mortgages and things like that. But you really want to prepare for the worst. And if you do your emergency fund, that's between you and yourself and your co-owner. Nobody needs to know about that. You don't need to be asked to borrow it from for other people to borrow it for their emergencies. This is for you. It's tucked away. It's secret. Only you know about it. And it's only used for the designated emergencies. It's not for paying off vacations or putting a new bathroom or going, whatever. So it's really emergencies. So principal and interest on your loan. Your mortgage payment is also, your monthly payment is also going to consist of your real estate taxes that we talked about, and it's also going to consist of the homeowner's insurance premium and your private mortgage insurance if you're getting a mortgage that requires that. So principal and interest, taxes, and insurance. So that's the components, the anatomy of your monthly mortgage payment. Okay, now the next topic, down payment assistance programs. If you're a first-time home buyer, and you're purchasing a property in the city of Lowell, we have 2 different down payment assistance programs that are available. So this portion, this couple of minutes, is only going to be of interest to people who are buying in the city of Lowell. So you have to be a first-time home buyer, you have to be buying in Lowell, and your income has to be within the program limits. So there are 2 programs. You have to figure out which one you're eligible for. The 2 programs are the City of Lowell's Home Program, federally funded home program, and the other one is funded by the Lowell Development and Financial Corporation, which is a wonderful nonprofit organization in Lowell. So these are the income limits for the City of Lowell program, the first program. So if you're one person in the household, you can make up to $52,850. If you're 2 people in the household, you can make $60,400. That's the maximum you can make. If you make that or less, you're eligible. Now keep in mind, these income limits change over time. So depending on when you're watching this video, they may have gone up or gone down a little bit. And so they're always, the most current numbers are always on our website, or just call us. But they will change a little bit, but not a lot. So anyhow, that's the first program for the City of Lowell. If you qualify for this program, currently the program is set up to provide up to $11,800 in assistance. That's money that you can use towards your down payment and or closing costs if you're buying in Lowell. And so call us to determine your eligibility, and we'll go over the program with you and ask you all the questions that we need to know to determine your eligibility. We do it all the time. It's easy. And make sure your lender utilizes these programs. If you're interested in these programs, then when you're shopping around for a lender, this is one of the questions you'd want to ask them right up front. I'm going to be buying in Lowell and I want to use the down payment assistance program. Are you familiar with that program? Do you use it? How many have you done? If you're not used to it, haven't used it in the past, are you willing to learn? Call us. We'll let you know who uses the program. So anyhow, if you do get that assistance, this is a no-interest loan. This is not a grant. It's a loan. It's a lien on the property in second place behind your mortgage. It has to be paid back when the property is sold or refinanced down the road if you take cash out. So basically, it's a no-interest loan for as long as you own the property. And so if you get $11,800 and you sell the property 5 years from now, at the closing table, you would pay that money back at no interest. If you sell the house in 30 years, you'd pay back $11,800. So it's a no-interest loan for as long as you own the property. It's a wonderful program. Gives you money up front when you need it to get you in the door. That's the whole point. When you pay it back down the road, it's used to fund a future first-time home buyer. So it's recycled and it's wonderful. So the other program, if you're over income for the City of Lowell program, we have the program that's funded by the Lowell Development and Financial Corporation. Currently, their income limit is $147,000. So regardless of the family size, the maximum amount of income is $147,000. This program will provide up to $5,000 of assistance, and you do have to pay this money back starting after 5 years. So typically, if you get the full $5,000 on the 5-year anniversary of your loan, you'd pay back $1,000, either monthly or once a year, and then you pay it off. But you pay it off in years 5 through 10, no interest. So again, it gives you the money up front and helps you get it in the door. So anyhow, those are the 2 down payment assistance programs. They're terrific. We really encourage people to use them. We've done hundreds of them over the years. Millions of dollars have gone out to help first-time home buyers using these programs. We love doing them. So, if you're eligible and you could use the boost, that's money that's, kept in your pocket to help you pay, emergencies or repairs or things like that. So that's that. Okay, let's see. The next thing, do your homework on these programs, read the instructions, organize all your documents, be prepared for the process. Call us, the Merrimack Valley Housing Partnership, to determine your eligibility and the next steps. And work with reputable lenders who know the programs. Okay, next topic, homeowners insurance. I'll go through this pretty quickly because I did talk about it already. Insurance binder, you have to get that before your closing. It's required by the lender. You have to purchase your homeowners insurance the first year in advance. Ask a lot of questions and know your coverage. How do you get homeowners insurance? Typically, homeowner insurance agents shop around, get quotes. It's pretty easy to do. Compare the costs and the different types of coverages. Credit scores do weigh into the insurance premium that they're going to offer you. And find out if you're in a flood zone. Very important. When you're looking at a property, ask your real estate broker, is this in a flood zone? If it's in a flood zone, you can still buy the property. However, the bank is going to require that you buy additional insurance, which is flood insurance. That can be very expensive. So you want to get estimates. You want to know what, if it's in a flood zone, and if yes, how much would the insurance be on that? So talk to your insurance agent at the same time you're shopping around. So the features, what does homeowners insurance cover? It covers the dwelling, that's the house itself. It covers any other structures, whether you have a garage or a swimming pool or something like that, or a shed. Personal property, this is your clothing, your furniture, jewelry, things like that. Keep in mind, a typical homeowners insurance policy has very low payouts for things like personal property. So if you have anything of value, artwork, coin collection, jewelry, you want to talk to your insurance agent about that and have that purchase additional insurance to cover costs above what the maximum is that they would pay out on a standard policy. Loss of use. This is an option that we encourage you to look at or ask about. It doesn't cost much to add it. This is if it's February and we have a power failure and your water pipes freeze and there's damage in the house. And the house is uninhabitable for 2 months while it's being repaired. If you have loss of use coverage, this will pay for you to be in a hotel. And just ask what it costs, because it's really not much more, and it's probably a good thing to have. Personal liability, if somebody falls or gets hurt on your property. Medical payments, coverage to other people. Deductibles. You have to choose what deductible you want, and then sometimes there are discounts if you belong to, different associations have discounts, so you want to ask about what discounts are available. Very important, and very few people think about this, is we really encourage you to have an annual checkup on your insurance. Just like you're supposed to go to the doctor and have your body get an annual physical once a year to know how's your body doing. Call up your insurance agent once a year and just review your policy. What do I have this? Have you made any improvements? Have you done anything? Has anything changed on the property? What about loss of use? What about, should I increase this? Or what about my deductible? And just stay current. Most people buy insurance, pay for it, put it in the drawer, and never think about it until there's a reason to think about it. And that's when they find out that they don't have enough coverage or whatever. One quick note about condominiums. If you're buying a condominium, you're buying condominiums have master insurance that protects the building itself, usually from the studs out. You pay for that, your portion of that through your condo fees. But that master and condo insurance does not cover from the studs in. That is your appliances, your floors, your walls, your ceilings, your electricity, all that stuff. So if you're buying a condominium, we still recommend you buy, the homeowner's insurance. It's going to be less money. It's more in line with what renter's insurance is, but it's going to be less. But you should definitely make sure you're covered. So anyhow, get your annual checkup. The deductible, you select if there's an event, a claim. How much do you want to pay yourself, and how much do you want the insurance to pay? If you got a $500 deductible, the premium is going to be it's going to be higher than if you get a $1,000 deductible. So you can save money by selecting a higher deductible. When you think about it, people don't have that many claims on homeowners insurance. My personal suggestion is to go for a high deductible, like $1,000, because the difference what you're going to save on your premium to save $500 if there's a claim, doesn't justify it. So but ask your insurance agent to give you prices based on various deductibles so that you can make that choice. Okay, get your annual checkup. If there's a change, address, or anything like that, let your insurance agent know about it. Some people look at umbrella policies. Umbrella policies are policies that include that's additional coverage for people who have a lot of equity in their property or a lot of assets. So something to think about. Don't be afraid to call anytime with questions that arise from your insurance agent. So that's insurance. Now, legal issues, new topic. Okay, the legal issues. Your personal attorney is the one that's going to review your offer to purchase and your purchase and sale agreement. The lender's attorney closes the loan. Now, there's a few things that are very important to know about. Important considerations, and this typically has to do with the closing attorney. Okay. 72 hours before your closing, you will receive what's known as the closing document. This is a standard document that goes to every mortgage closing in America. And the closing when you apply for a loan and you get pre-approved for a loan, you're going to get something known as the loan estimate. And then at the closing, you're going to get the closing document. There are very strict rules regulating lenders about any changes that can happen between the numbers on those two documents. Closing documents are a lot of consumer protection built into this. So 72 hours before your closing, you're going to know exactly how much money you need to bring to closing, what every fee is going to be, everything. So there are no surprises, there's no last minute changes. And so it's a consumer protection thing. So really get that document and study it and really go over, call your lawyer, whoever, and go over it so you understand everything that's on there. So it's a huge improvement over a system we used to have, which was people finding out 10 minutes before they're closing how much they needed to bring. So anyhow, that's something to expect. Another thing that I want to talk about that's really important is title insurance. You are required to buy a policy that protects your lender. we suggest that you also buy coverage for yourself. So in title insurance, first of all, title insurance is a type of insurance that's set up to cover items that claims against the title on a property that weren't discovered through the normal title search that attorneys do. These happen sometimes with documents being misfiled or mortgages not being discharged. There's all kinds of things that can affect the title. And so it's enough of an issue that the banks require the buyers to ensure to protect the lender in case a title issue arises in the future and it's going to take money and time to solve the problem. So they require you to buy a title insurance that protects them. This is a one-time insurance that you pay at the closing, and it's in effect for as long as you own the property. So it's not like automobile insurance or medical insurance. You have to pay a monthly premium or an annual premium. This is one-time fee. So you're required to buy title insurance to protect your lender and pay for it at the closing. You are given a choice at the closing whether or not to buy coverage that extends the coverage to you. Strongly recommend that you buy it. This is a type of insurance that typically title issues, you're going to find out about a title issue when you go to sell the property and the closing attorney discovers something that wasn't discovered before. And then what are you going to do? You're a week before closing, and now you've got a legal issue that has to be resolved. So title insurance will, solve the problem and pay for the whatever legal work needs to be done. So it's just peace of mind, and if a title issue ever arises, you'll be very happy about the policy. So let your closing attorney know prior, week or so before the closing. By the way, I also want to buy owner's coverage for my title insurance. The next thing you want to remind the attorney is to let them know that you want to file a homestead. A homestead, it's the Homestead Act. This is a one-page document that you file at the Registry of Deeds at the time of closing. And it's basically a public declaration that says, this is my home. This is my primary residence. Just by having that homestead filed, it's going to give you protections against creditors, if that ever arose. This would be if there was a claim against you for unpaid bills or an accident or something like that. Your house is protected. The creditor cannot force you to sell the house to satisfy the debt. Your house is off the table because it's your primary residence. You may still owe the debt, but you don't lose your house. And so, of course, the IRS, the Department of Revenue, child support, your mortgage, and all of those things you still have to pay those things. The Homestead Act doesn't give you coverage for that. But it's a good thing to have. It costs $45. You file it once. It gives you peace of mind. And then after, speaking of legal issues, after your closing, think about, after things settle down, you moved in and all of that, within the next 6 months, think about making an appointment with an attorney and doing some basic estate planning. That would include preparing a will and preparing a healthcare proxy. A will is your last will and testament. If I pass away, what happens to my house? Who takes care of my children? What happens to my furniture, my art collection, whatever? Who gets my bills? And so that's if you die without a will or what's called intestate, then the court system is going to determine what happens to your estate. And it's much better to, it's the best gift you can give the people you leave behind, to give them, a clear vision of what you wanted. Saves a lot of money. It's a lot faster. And what happens is what you wanted to have happen. The other thing that's just as important is the healthcare proxy. This is like the living will or the healthcare proxy. This is, what kind of decisions do you want to be made while you're still living? If you were medically unable to make decisions or act or anything like that. So saves a lot of conflict in families and a lot of peace, provides a lot of peace of mind. So think about doing some basic estate planning down the road. Makes your life and everybody else's life, a lot easier. Okay, so we're getting close. Just a few last things. I did mention landlord training. If you're purchasing a 2 or 3 family property and you'd like it, before you buy, we really encourage you to take our landlord training class, so that you really go into it, with both eyes wide open. Once you close, another thing is to schedule a free energy audit through Mass Save after you close. Every month when we pay our electric bill, there's a portion of our bill that's going in to fund the Mass Save program. This is an energy conservation program to help people reduce their utility bills and to become more energy efficient. So Mass Save will come out and spend a couple of hours and do an energy audit. They'll look at your heating system. They'll look at the efficiency of it. They'll look at they have machines that can determine the draft that you're losing. They'll be able to determine how much insulation you have. So they will give you some good suggestions about things that you can do to improve the efficiency of your house and thus reduce your utility bills. And utility bills are only going in one direction. So whatever you can do to help your wallet as well as help the planet, take advantage of it. We already pay for it anyhow. If you're doing bigger ticket items like putting insulation in or whatever, they have terrific programs to share the cost with you, low interest loans or various promotions that happen from time to time. But it all starts with getting an energy audit. It's free, it's very useful, so call Mass Save and schedule that. We also have the Merrimack Valley Housing Partnership. We perform intake services for people who are trying to abate the lead in their houses. If you're buying a house that was built before 1978 and has not been brought into compliance or de-leaded, there are some programs that can help you with that. Call us if you'd like more information about that. And one very important thing that I'd like to mention is that at the Merrimack Valley Housing Partnership, we also do individual financial and credit counseling. So this is an opportunity to sit down for a couple of hours with a homebuyer counselor and go over your own personal situation. We'll look at your income, your assets, your household budget, your credit history, and help you. We can give you a readiness to buy assessment. If you were to walk into a lender tomorrow, what would you expect to hear? So we can, give you a good assessment of where you are, help you figure out a plan to become credit worthy if you're not quite there yet. If you are ready to qualify for mortgage, we can give you an idea of what your price range would be. So it's very helpful. You can open your eyes about certain mortgage programs. And also, it's an opportunity for us to help you figure out if you're eligible for down payment assistance programs or anything else like that. So all you have to do is call our office to schedule that. And you're only a first-time home buyer one time, so make it a great experience. Yes! So anyhow, well, that was a lot. I thought it was going to be an hour and a half, and it was an hour and 24 minutes approximately. So anyhow, thank you very much. Congratulations on taking a homebuyer training course. We're here to serve you. If you have any questions down the road, we're happy to help you. It's not a race. Home ownership is a wonderful thing when you're ready for it. So I wish you the best of luck, and thanks a lot.